But today we're very fortunate to have another very distinguished guest speaker with us. So Evan Katz is the founder and managing director of Crawford Ventures, which is a firm that specializes in relationships and business building and raising capital for hedge private funds. He's got a wealth of knowledge when it comes to how to properly structure your firm for success, and when you're out there trying to do what, the goal of all this is to raise and to talk to people about your business and raise and attract capital. He also has some great, obviously some great career advice, some advice about the industry. And Evan, if you don't mind, I'll kind of turn it over to you and walk through some of the stuff we discussed, and then obviously we always look forward to a very robust Q&A towards the end.
Okay, great guys, thank you very much. This is my first time ever teaching an MBA class during a pandemic from roughly 2,500 miles away. But initially, thanks, of course, to Mick and to Rob and USC for having me. It is great to be here. As they mentioned, again, my name is Evan Katz. I'm Managing Director at Crawford Ventures, Inc. We are headquartered in New York City, so greetings from New York. Although, as I mentioned to Mick and Rob, my brother-in-law happens to live in Redondo Beach. So we are in Southern California, often on the Strand or someplace like that, not infrequently. So hopefully when this whole pandemic thing is over, if I do a good job today, I'll be invited back to speak, and we can do this in person. I actually do have my mask here as well, but I'm not going to wear it because I think we're more than 6 feet apart. 2,500 miles probably qualifies for that, so I will skip wearing my mask. I'm going to give maybe 30 seconds, a brief introduction, then we'll dive into hedge funds and operations and fundraising and whatever else that Mick and Rob and you folks actually think is important. I did get about 9 questions in advance. We had asked for questions in advance, and I prepared answers to them. But again, if anybody has additional questions about hedge funds, alternative investments, fundraising, operations, careers, pretty much whatever comes to your mind. The questions we got were great. Please, however one does this, either somehow, whatever one does, text them to Mick or Rob, put them in the chat, and after the 9 questions we got early on, we'll get into those. So brief 15-second background on yours truly. I'm a native New Yorker, grew up on Long Island, the suburbs of New York. Went to Wharton, was a finance major there. And I'm pretty darn sure that when I went to Wharton, I won't say how many years ago, there was no hedge fund class there. So I'm very thrilled that USC and some other schools are having them as well. I've spoken at a couple of universities regarding hedge funds. Seton Hall was one, a few others as well. So I'm glad USC has the program and thrilled to be here today. Did also go to law school went to law school actually at Harvard, same class as Michelle Obama, I guess then Michelle Robinson, for full disclosure, so small world. The joke on Wall Street is if I had married Michelle, I'd be president. Although my wife, who's much smarter than I am, thinks if I had married Michelle, Michelle would be president, and she's probably right. Long story short, practiced law for a bit, intellectual property, computers, technology, patents, trademarks, copyrights, trade secrets. If anyone, for any reason, offline has any questions about intellectual property, was one of the top computer technology and IT lawyers, been on Wall Street for almost about 20 years, mostly in hedge, venture, and private equity. As some of you may have seen from the background, was twice elected to the Hedge Fund Association Board of Directors, served on it for 6 years, have roughly about 50,000 subscribers to our hedge fund email newsletter. If you'd like to subscribe, there's a link on our website. As I should also mention, my wife is a senior director, executive director at Morgan Stanley in New York City. The last thing I'll mention is to give you some idea of what we do when we're not doing finance and Wall Street stuff. We both love cycling and wines, and actually had a wine-themed wedding in New York, not Sonoma. People ask that a lot. So as you heard, we basically help hedge funds and private equity and venture funds and real estate funds grow and prosper. That's lovely. What the heck does that mean? It's different for every fund. For the $1 billion fund, we'll just raise them the next billion. We'll get into how we do that in a few minutes. For smaller emerging managers, depends on your definition of small, a couple of $100 million, whatever small means these days. We'll help them with compliance, legal, operations, build out, pretty much whatever else it is. But what we're known for, I guess, globally is fundraising. actually this year, last commercial, I promise, Crawford got nominated and voted as the industry's top fundraising firm in the Hedge Week annual 2021 awards. But that's what we're known for the most. We have relationships with roughly about 1,000 endowments, foundations, fund-of-funds, high net worth families, broker-dealer platforms, RIAs. They have somewhere around $6 or $7 trillion of capital. A manager recently asked me which it was. I said, dude, does it really matter? It's a lot of money. And their typical allocation is roughly $25 to $250 million per investor per fund. Okay, so enough of the background, enough of the commercial. I was going to say, I can't see everybody there live, but maybe Mick or Rob, you could just tell me, by a show of hands, how many people have ever worked at a hedge fund?
One.
We only have one so far.
One that would admit it.
Okay, one so far out of roughly 50 or so. Second related question, perhaps, how many think that you might ever want to work at a hedge fund? Okay, fair enough. Well, hopefully I'll persuade more of you to do so, or at least give you some idea of what makes a hedge fund run well for those who do or do not end up going into the industry. With that said, I guess let me ask Mick or Rob to pull up the PowerPoint, and I will go through at least some of the slides on that. Again, I would love to get questions. Let me get through the first 3 or 4 slides, but then after that, I would love to get questions about any aspect of the industry and make this as interactive as possible in a pandemic and 2,500 miles apart, if that's okay. And while you guys are pulling up the PowerPoint, I will say also, if anybody who wants to stay in touch after this, if you go to our website, crawfordventures.com, my email address is on the website. We also have on the website a newsletter you can subscribe to regarding hedge funds and alternative investment funds and fundraising and investors. And no surprise, in 2021, you can also find me on most of the social things, LinkedIn, Twitter. We also have a ton of videos on our YouTube channel, so you can get in contact with us there. Okay, great. I guess next slide, and let me see if I have to pull this up locally or if I can see it sufficiently. Yeah, what I'll do is just give me 2 seconds. I will pull it up. I will pull it up locally. I'll pull it up locally here, which probably is a good idea. Just 1 second. Okay, great. While I'm pulling up locally here, my apologies perhaps for showing the USC hedge fund class presentation given at the Wharton Club, but I think everyone gets along these days, and it's a small street, so with apologies for that, let me just pull it up. Okay, great. So what I will do is, I think the pages are numbered. I'll just sort of say which one I'm on. I guess
Hold on
obviously.
Hold on 1 second, Evan. For some reason, let's see. Do you want to share it with? Do you want to share the screen, or do you want me to do it?
If you could do it, that would be great for various technological reasons. Do you have a copy of it, I think?
Yeah. Let me.
Okay, great. Looks like you've got it. As somebody very astute once asked me, yes, that is a picture from my wedding day with the fancy bouquet background. So that is the wine-themed wedding day picture. Okay, great. Maybe just to go to slide 3, the table of contents. Won't dwell on this too long, but just to give people a quick idea of what we're going to cover. Basically, some differences between family office and institutional investors, best practices for doing fundraising from either or both of them, a lot of tips and tricks about how to raise capital for hedge funds, both generally and also including the monthly hedge fund update that hedge funds typically send out every month as a way of staying in front of investors and hopefully letting the investors know how well the hedge fund is doing. A couple of things for fundraising during COVID, which we are still sort of in a little bit of, things have gotten a bit back to normal. And then again, time for Q&A. So slide 4, this was actually originally 26 tips and tricks for raising capital for hedge funds. We're now up to 55 at CCC, and we'll take it from there. Slide 5, you've already gotten the background, but if you want to leave it up for just 5 seconds, if anyone hasn't grabbed the email address, feel free, but it's on our website. Slide 6, we basically already covered some of our institutional investor relationships. We can leave it up there for a second. But then let's go to probably the most important slide of the deck, which is slide 7, which is a great hedge fund cartoon. It's always good to start off with a cartoon. Those who may or may not get the joke, I'll explain it for those who don't. Historically, Greenwich, Connecticut has sort of been the informal capital of the hedge fund industry. Things started there when Greenwich had, when the state of Connecticut had no income tax. So if you were making substantial capital, a lot of people relocated to Greenwich because there was no state income tax. As some people may know in the industry, or you may have heard, the 2 and 20, of course, is the standard hedge fund fee. You get 2% of the 2% management fee on the money you're putting to work and investing for your investors, and 20% of the profits that you make, hopefully, for your investors. So entering Greenwich, speed limit 2 and 20. I borrowed this from a friend many years ago. As you may have heard also, there's been a bit of fee compression. Some hedge funds haven't done as well as people thought they should have, probably because when things are going straight up in a bull market, it's hard for hedge funds to compete when the S&P is going in a 45-degree angle due to quantitative easing or what have you. So I said at a seminar with a couple hundred people, maybe somebody should update this slide to reflect the somewhat lesser hedge fund fees that came out after the last couple of years and after the crisis. Next slide, slide 8. Somebody actually did that and changed it to 1.5 and 15. Very nicely done. So, all right, that's the hedge fund cartoon. Let's dive more into the meat of the matter. So slide 9, 55 tips and tricks for raising money from institutional investors and family offices. And these are really critical. A lot of hedge fund fundraisers are kind of smile and dial and spray and pray, and the email blast investors and hope that it sticks against the wall. Not surprisingly, perhaps, you rarely accomplish very much. There's a lot of best practices and a lot of dumb things. We'll get to both. I'll mention 1 or 2 of the dumb things just to give you some idea how otherwise bright people are not great fundraisers. There's one great fund I know sends out their update on a Sunday, every month on a Sunday. Why are you emailing people on a Sunday? They're either with their family, they're with their kids, they're seeing their friends, they're out playing ball, they're on the beach. They're not looking to read your hedge fund update on a Sunday. And there's a slew of things that should be simple and obvious that aren't. Okay, slide 10. People often ask me, how are family offices different from institutional investors? Are they the same? Are they different? How do you approach them? And there's a couple of things here that are critical. Many institutional investors don't love to be cold called, but the family offices typically hate it. And it's also hard to even find out who they are. So, when I broke into this business 20 years ago, the institutions, the endowments, the pensions, the foundations, between a lot of hedge fund conferences, I've been to over 1,000, a lot of Googling, a lot of networking, a lot of LinkedIn, you can maybe identify who is in charge of hedge funds at the major pensions, endowments, schools, policemen of this, firemen's retirement fund of that. Although you won't have relationships with them until you've gotten to know them over a decade or 2. But family offices are a lot more difficult. They're rarely in databases. There are some lists you can buy, and they hate getting cold called. They're typically much more private. So, one of the things that we'll sort of cover here maybe once or twice is, if you're looking to build your fund, to grow your fund, to start a fund, or to raise capital for a fund you otherwise work at, it's a question of either build or buy. You can build or buy. You can spend 20 or 10 years trying to get to know every investor in Kingdom Come, or you can hire someone like me who knows everybody. And I'm not the only game in town. This is not just talking my book. There's other fundraising firms, but this is really an area where you can't have long-term relationships. As Jerry Seinfeld would say, You can't have a long-term relationship with someone until you've known them for a long time. So this is definitely an area where you want to bring someone on board who already knows the family offices, who already knows the institutional investors. They take his or her calls, because that's probably the best or worst kept secret on Wall Street. The investors get thousands of pitches, often thousands. And if they don't know who you are and they get your email, they're probably not going to read it. So hire someone who already knows them, will get the emails done. Okay, slide 11. What are endowments institutions looking for versus family offices? And this is critical because the most important thing about sales is fishing in the right pond and trying to make a good fit with the people you're pitching and the product you've got. And some of the questions, we'll get to that later. But one of the critical things is the type of return streams that investors are looking for. So if you are at a low return, low risk, low volatility hedge fund, you're probably want to spend some time on the family offices, but go more after the institutional investors. Why is that? I guess we'll take the family offices first. Most family offices would rather have high returns and high volatility for a variety of reasons, including they pay taxes. If you live in most countries, you pay tax. And if you live in California or New York, and you're a family, you often pay a lot of tax. So if there's a great hedge fund that makes 6, 8, 10% a year, 11% a year, and most years, some down years, but is kind of chugging along at the high single, low double digits, that's a great fund. I mean, that's a great sort of the proverbial equity-like return with bond-like volatility. But if you're a family office or a man or woman and a family living in California or New York, after taxes, that doesn't leave very much. So if you're one of those type of singles and doubles funds, doing 6, 8, 10% a year, you probably want to focus more on the endowments, the pensions, and the foundations. Because if you can make them 6, 8, 10% most years consistently, where they don't have to worry about your fund and what's going on, they will name their firstborn after you, and they will be one of your best friends and biggest investors. Because most of them have what they call their bogey. Whether it's a pension, a foundation, or an endowment, there's that 5 to 6 to 7 to 8% a year they want to make. Because if USC can make that kind of money reliably, they can pay the teachers, help with financial aid, keep the lights on, repair whatever needs repair, that type of thing. So again, that's a critical point where if you're a singles and doubles fund, focus more on the endowments, the foundations, and the pensions. Conversely, if you're more high risk, high return type fund, definitely spend some time on the pensions, the endowments, but the family offices may be more friendly to you because they're looking for the higher return and the higher post-tax return. Okay, let's go to slide 12. The other thing is tax efficiency. This may be a bit inside baseball or getting into the weeds, but let's just put it out there. Most hedge funds are not tax efficient. You're tax efficient if you have long-term capital gains. You're tax efficient if you have certain qualified dividends. You're tax efficient if you have certain futures that get taxed mostly at corporate, long-term capital gains. But most hedge funds aren't. So if your fund happens to be tax efficient, put it on your one-pager, put it in your PowerPoint, big letters with stars and rainbows all around it. Because if you're making 8, 10, 12, 15% a year for your investors and they're in a high tax bracket and you're tax efficient, you're actually making a lot more than that when you consider taxation. Again, this is something so incredibly obvious that you should say, what? Of course, everybody does it. Shockingly, no. You know, we probably get 300 to 400 hedge funds knocking on our door every year and other funds wanting us to raise capital for them. And maybe the 10, 20, 30% that are tax efficient or somewhat tax efficient, the vast majority don't say it. And it's one of those sort of slap your head kind of moments like, why aren't you saying that? Because it makes your fund a lot more attractive. The only reason one fund gave once is they said their lawyers wouldn't let them do it because just because they were tax efficient for the past 10 years doesn't mean they're going to be tax efficient next year or this year. And I said, wait a second, I'm a recovering lawyer. If you can have a one-pager with your 10-year track record with the usual disclaimer that you may or may not do as well next year, you can have a similar thing on your document saying that you have been tax efficient, no guarantees except death and taxes. So again, if you are tax efficient, put on your documents. Again, on slide 12, point G, this is a little bit inside baseball, but I'd be remiss if I didn't mention it. If someone asked me, and they do sometimes, what's the best kept secret in the world of hedge funds that most people don't do, it's something called an insurance dedicated fund. I'm not sure if Mick has covered this before, but to make a long story very short, There's a way for families and high net worth individuals to invest in hedge funds through insurance, which can make the investments grow tax deferred or tax free. And there's only one thing better than a great performing hedge fund or venture capital fund or private equity fund. And that's a great hedge fund or private equity fund or venture capital fund that you can invest in on a tax deferred or a tax avoided basis. Why don't people do it? I think sometimes it's a little bit complicated. They're not too familiar with it. And like most things in life, the greatest force known to man and womankind is inertia. They never did it before. But something to make a note of, if your fund offers it, it can make your fund more attractive to investors if you have a private placement, a PPLI, private placement life insurance dedicated fund. So worth noting. With that, I'll go to slide 13.
Hey, Evan,
Sure.
if you get a chance afterwards, if you think about it, could you send me some funds that are set up like insurance dedicated funds? And in particular, like I've seen this used more in a sort of a private equity kind of format, but I'd be interested in exploring that a little bit more. And I have not brought that up to my students yet, but I definitely will.
Oh, listen, absolutely.
Appreciate it.
Yeah, sure. No problem at all. Will do. One of the things on slide 13 I want to mention, another great point, is point H. One of the better things about most hedge funds is that they are less or negatively correlated or lowly correlated to pick your benchmark, the S&P 500, the hedge fund indices, of which there are several better known ones. And so one of the ways that one can help raise capital is, and this is pretty standard stuff, is to emphasize to prospective investors, your fund makes on average a certain amount a year, its Sharpe ratio is a certain amount, and also whether it's correlated much or less or even negatively to the S&P or the hedge fund indices. Because what you can do is to put together an example for a family office or a pension or an endowment. So let's say you're going to a great school, let's call it USC. You're going into USC to pitch them on your hedge fund and ask them for $200 million, whatever their latest number is that they invest per fund. And you can go in there and give the standard pitch as to why your fund is great and go through the PowerPoint, and one should do that. But one of the best tips and tricks in the business is to do your homework. It's not just to go in and pitch USC as you would Harvard, Princeton, UCLA, and give the exact same presentation, but also to actually dive a bit deeper. And what do I mean by that? Most public institutions, fireman's pension, teacher's pension, policeman's pension, and universities, they have to make public what their investments are. So if you or one of your colleagues can spend some time, pull from the USC investment committee notes, the actual hedge fund portfolio of USC, and then showed to the prospective investor, in this case USC, a mock portfolio where you've taken their current hedge fund portfolio, you've added in your hedge fund with, say, maybe a 10% allocation or 5% allocation, and if your hedge fund is less or negatively correlated to most hedge funds in the markets, it's going to make a great impact because it shows them that not only will you increase their expected returns, you'll also decrease their volatility. And again, it's an if. If your fund is less or negatively correlated to the S&P. That can be very powerful. We've done that several times. Somebody once asked me, is it a bit, to use the word stalkery perhaps, of having having done your homework? And the answer is not really no. The answer is no. Basically, allocators appreciate the fact that you've gone through the trouble to do all that homework. So if you are less or negatively correlated, spend the time, and it's going to be a bunch of hours to show how their performance will increase if they include you to their hedge fund matrix. Going on to slide 14. This is regarding multifamily offices. I've actually covered this already, but this is also probably sometimes overlooked a little bit. Obviously, a single family office is one family office. The Smith family, the Jones family, the matriarch or the patriarch made their fortune typically selling an operating company 5 to 500 years ago. I mean, anything from Michael Dell's family office to the Ford Foundation and their family office, the Rockefeller family office. They can be 5 years old or 100 years old. But there also are multifamily offices. And some of the great things about the multifamily offices are precisely that. They actually are just that, multifamily offices, where they are representing numerous families. And so if you make a great impression on the multifamily office, you can actually help to raise very substantial capital, multiples of what you might get from one or two families. And it may take a little bit longer, they may have a bit more bureaucracy or not, but if you can get over that hurdle, you can potentially raise orders of magnitude more than you would from just the single family office, the Smith family or the Jones family. So like the pensions and the endowments and the foundations, it may take a little bit extra time, but the bang for the buck can definitely be worth it. Okay, going out to slide 15, point K, OCIOs, so-called outsourced chief investment officers. Again, you may have covered this a little bit, but typically the endowments, the foundations, teachers of this, firemen of that, universities, USC, Princeton, whomever, typically have pretty large investment offices. Actually, I would say this, if you've never actually bothered, because when I was at Wharton, I never bothered to Google or look up or go on the website and look up the UPenn endowment office. But I would say most of it is public. If you haven't done it already, after class, sometime whenever over the weekend, spend 10 to 15 minutes actually going to the USC website, look up, it's either called the Office of Investments, the Endowment Office, but you'll find it pretty quickly. And just look how many people they've got there. My guess is they've probably got a dozen or more. And it typically breaks down, typically by subject matter. You've got a certain team in charge of long only, and the same thing at the pensions. You have a team that does long only, you have a team that does hedge funds, you have a team that does private equity, venture capital, long only, fixed income, et cetera, et cetera. And that typically is the case of most of the large endowments and pensions and foundations like a USC, University of Michigan, places like that. But what do some of the smaller schools do? And again, it depends on your definition of small, or some of the smaller family offices do. Well, they often have one or two people or three people working on their investments, but they also have an outsourced chief investment officer. And it is just what it says. It's an outsourced company that literally helps, in fact, often does guide them and often makes the investment decisions with the approval of the board, with the approval of the internal investment officer. And they're also a critical constituency because just like the multifamily offices, if you can get the OCIOs, as they're called, to approve your fund, it will take more work, it will take more time, it will take more effort. But if and when you do that, you can often get the windfall, so to speak, of getting multiple investors. Because I would say that for every 100 investors that the OCIO represents, depending upon the fund, depending upon how the stars align, maybe 25, 50, or even 75 might go into a particular manager depending upon their style, depending upon their strategy, and the time of the market cycle that we're in. So definitely worth doing the multifamily office route and the OCIOs as well. Moving on to slide 16, point L. And this gets sort of into the how do I even build my own hedge fund, or how do I get my existing hedge fund from 50 million to 100 million to $1 billion, whatever it is. So a couple of words regarding sort of emerging managers or new funds. And that is you're going to need staff and resources. So let me explain a bit about this. When I started in the business about 20 years ago, there was the old joke, you could make it if you were two guys, a gal, a dog, and a Bloomberg, kind of like the Steve Jobs, the Jobs and Wozniak out of the garage version for hedge funds, where, bring it and they will come. If you put up great numbers, you could raise a ton of money without having the need to have a big staff or even a medium-sized staff. After the Great Recession, 2008, 2009, 2010, those days are gone, and after Bernie Madoff as well. At this point, yeah, there are some folks, family offices, we have relationships with several hundred, that will invest in the proverbial one or two man or woman band. But typically at this point, if you really want to get to the next level and raise a couple of $100 million, $1 billion, whatever the number is that you're shooting for, you're going to need staff. Doesn't mean you need 50 or 100 people. If I had to put a number on it, 5 to 10 can be fine. You can start with 5 and work your way to 10. So this brings to mind one of the biggest pitfalls of the hedge fund industry. So I will say two things about hedge funds and the industry and building a fund. The best thing about it and the worst thing about it. The best thing about hedge funds is you can form a hedge fund with a guy, a gal, a dog, a Bloomberg, and $1 million. And that's the best thing about hedge funds. The worst thing about hedge funds is, well, you can form it with a guy, a gal, a dog, a Bloomberg, and $1 million. So what's my point? To put it in baseball terms, because I think it's a great metaphor, you can get to first base very easily in hedge funds. You can get to form your hedge fund with $1 million, $2 million, whatever the number is. You can get to first base easily. The problem is it's very hard to get to second, third, or home, whatever your definition of those numbers are. So, we've seen over the years thousands of managers who've asked us to raise capital for them and to bring our investors to them. Some are large, some are small, some are medium, and everything in between. But we've seen a lot of them fall into the pitfall where they kind of get to first base with their $5 or $10 million hedge fund, and they don't have the resources to get larger. And so, I would say, if you're going to form a fund or try to build one, don't do it unless you have the capital put to work. So, again, recovering lawyer, I'll give you my best metaphor and analogy. Mick and Everett are going to form our favorite cuisine, the world's best Italian or French restaurant. We're going to put it in Redondo or Manhattan Beach, and we're going to make millions of dollars. And of course, the old joke is, the way to make a little money in the restaurant business is to start with a lot of money. So we go to our local accountant, and he or she says, okay, guys, you're going to need a couple of $1 million of operating capital, and you're going to need it for hiring and a 10-year lease and all sorts of other fun stuff. And if we don't have the $3 or $4 million of operating capital, we're not starting to build our restaurant business, because to hire everyone and to get the space and everything else is preclusive unless you have the capital. But that's not it in hedge funds. And a lot of people do it without having the capital to do it. So what does somebody do if they don't have the capital to do it, or they started and don't have it then? And I would say probably the best kept trick, and a lot of people don't do it, is to pass the hat. You're going to need $3 to $5 million. Five's a bit high, but more than 1 or 2. $3 to $5 million, at least 3 or 4, to really do your hedge fund right, to hire the people, to hire the analysts, the fundraiser, the lawyers, the accountants, and to really, really do it right. And if you don't have it, you should probably go to your friends and the 4S, your friends, your family, former colleagues, and former investors, and have them put it up and sell them a piece of your fund. That is not have them invest in your fund like a regular limited partner invests in a fund, but have them actually invest in your management company, in your general partner, in your investment advisor. And if you've got to give away 20 or 25% basically of your business, but to get to $3 to $5 million of operating capital, it'll be the best trade you ever made. As I said before on panels and to the press, take your pick. Bill Gates and Steve Jobs and Jeff Bezos did not become billionaires by owning 100% of Microsoft or Amazon or Apple. They became billionaires because they raised money when they had to, sold pieces of the firm when they had to, grew their business and turned it into $1 trillion, or in this case now $2 trillion company. And the same thing applies with your hedge fund. As I say in the bottom of slide 16, it is vastly better to own 75% of a $500 million fund than to own 100% of a $25 million fund. And again, you may be saying, this is Captain Obvious. You don't need to have an MBA from USC to figure this out, but it's amazing how many managers won't do it. There are some managers who would rather part with their firstborn and have you crash their car than to give away 1% equity in your fund. But again, they end up typically staying as emerging managers forever. So, if you've got to give away 20% to grow your business and to make a lot more money than that, it's the best advice I could ever give people. Slide 17, let me say a few things about service providers. I don't know, Mick, have you covered service providers much yet or not yet?
We have a little bit.
Okay, fair enough. I mean, I figured as much. So, service providers is sort of the third-party constellation of folks in the Swiss Army knife of hedge funds, to mix several metaphors. The accountants who do the audit, the administrators, the prime brokers, the technology people, and I'm forgetting somebody probably, cybersecurity these days and so forth. And, again, this gets back to, do you have the $3 to $5 million of operating capital to hire the best service providers? Does the accounting firm have to be Big Four? I'd say probably not. There are some phenomenal hedge fund audit firms below the Big Four. On the other hand, it can't be Fred's law firm with 3 guys in white plains. And I will not ask for a show of hands because I'm not in the room, but does anybody know what famous, it wasn't a hedge fund, but say a hedge fund, what famous financial firms, accountants were literally 3 guys in a strip mall in White Plains? Does anyone know this fun fact? I can't see any hands up or no?
Nope, no one.
Yeah, fair enough. Actually, Bernie Madoff, no joke. Bernie Madoff was running billions of dollars, and because he was former chairman of NASDAQ and had the greatest returns since sliced bread, 1 or some % every month, his auditors were literally 3 guys in a strip mall in White Plains. And, if you ask anybody, would you ever invest in a fund whose auditors were 3 people no one ever heard of in a strip mall anywhere? The answer would be no. But because it was Bernie Madoff, it was literally many people invested. Many didn't, but many people invested. Actually, small fun fact, I actually grew up about a mile or 2 from Bernie, Mark, Ruth, and Andy. That's a 5-beer conversation for another day, and obviously a Greek tragedy. So I'm not saying your auditors have to be one of the Big Four, but they should not be someone no one's ever heard of. And the same thing with the admin and your lawyers and everybody else too. And also too, most service providers will do what in the industry, some people call the Evans special. If you're a growing manager, they'll work with you. They'll work with you basically for half price the first year, maybe 75% of full fee the second year, and then third year you're on your own. I mean, and that's only fair. So get good service providers that people know, because again, investors are getting thousands of pitches. They're going through them, and if they get it from somebody that they never know, they're probably not going to read it. We've actually done experiments. There was one fund that wanted to hire us, and that actually tried cold calling and cold emailing hundreds of investors, and we compared it to what our response rate is. And again, this is anybody who knows investors well. The warm introduction raises order of magnitudes more money. It's like I once said on a panel, if 2 people are walking down the street towards each other, and they kind of look at each other, interested potentially, 99% of the time, they just keep walking past each other. It's just the way it is. They look at each other, but nothing ever happens. It's awkward. 99% of the time, nothing happens. If those 2 people get set up on a blind date, they're going out Saturday night. It's the warm introduction. So again, make sure you get a fundraiser who knows people, who knows them for at least 5 or 10 years. Our investor relationships go back about 10 or 15 years. Half these people have got their cell phone, wives' names, husband's name, kid's name, dog's name. You end up raising a lot more money a lot more quickly. So, and similarly, make sure you've got once you've got a good fundraiser, service providers who are well known, because when institutional investors are going through, your PowerPoint presentation, whatever time of day or night, or on an airplane, they often say they're kind of check the box, and there's some truth to it. Good team, check. Good track record, check. Low correlation, check. Good academic credentials, check. Service providers. And if they've never heard of your service providers, it's going to be a conversation. Okay, that said, let me get into point N, fee structures. And this, again, should be somewhat obvious, but it's worth mentioning because most people have never experienced this before. Just like your service provider should be industry known, on your fee structures, keep it straight down the fairway as well. So, I mean, in class, Mick and you folks have probably gone over standard fee structures for hedge funds and private equity funds, and whether it's 2 and 20 or 1.5 and 20 or whatever it is these days, keep it straightforward. Keep it, as the golfers say, straight down the fairway. Do not get what I called in this slide creative. So I remember very well, out of the several hundred hedge funds and private equity funds that have come to us every year, There's always a couple who think they've got a better fee structure. And over the past 2 decades, I remember them well, there were 2 in particular. One was private equity, one was hedge funds that had a great fee structure. It was better. And here were several reasons why. And the truth be told, they were right. They were probably right. And it wasn't better for the manager, it was better for the investors. The alignment of interests was better, and you got it. The problem was they needed about a 2-page memo to explain the fee structure to me. And it took me, in one case, weeks to understand it, along with other things I was doing. And I said to them, listen, you may be right. If we got 5 PhDs from USC economics department and masters of finance to produce a 50-page report that said this is better, you're right, but you're wrong. You're right because it's better, but you're wrong because you're not going to raise assets. Because if it takes me 2 weeks to figure it out in a 10-page memo, you're trying to push a string uphill. And even if we do convince John or Jane Doe, who heads up hedge fund allocations at USC or Harvard or University of Michigan or University of Chicago, even if we do finally persuade them, when they go to their investment committee and they're looking at the Crawford Fund or your fund or whose ever fund, they're going to say, wait, what's with this fee structure? So the point is, if you're going to lose 20 to 25% of your investors over your fancy fee structure at the initial level, and another 20 or 25% of your investors at the investment committee level, the last thing you want to do is get fancy. Keep it straight down the fairway, 2 and 20, 1.5 and 20, whatever it is. And the same thing also goes, as I mentioned in point 0, with the fund entities. Delaware has been the place in onshore where 90-some% of hedge funds, private funds have been domiciled, as well as public companies. Same thing on the offshore side. Cayman is where 80-some% are. And by the way, yes, they actually pronounce it in Cayman. They actually say Cayman. So I'm not sure if it'll impress people or not, but they don't say Cayman, but everybody says it anyway. So again, just like the fee structure and the accountants and the auditors, keep it straight down the fairway. So when investors are going through your deck, it's like, yep, check, 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 and check. Going to slide 18. I think we already covered point P a little bit. Hire a smart fundraiser who knows your strategy. I've seen this messed up many, many ways over the years. Hiring fundraisers who don't know fundraising, straight out of school, and you can be the most brilliant person straight out of school, but you can't know people in the investor community for 15 years straight out of school. So hire someone who knows the investors and knows them well, someone who knows your strategy, and as point Q says, also someone who knows and has raised money for funds of your stage and size. So if you are working at a $50 million hedge fund and you hire the world's greatest fundraiser, but he or she has only been at billion-dollar funds, and 99% of his or her relationships are massive investors like CalPERS and CalSTRS and Harvard and the Ford Foundation, who have to write huge checks, and many of those folks will not write huge checks to small funds. You may have the world's greatest hedge fund fundraiser, but it's a complete size mismatch. You're fishing completely in the wrong pond. So make sure you have a fundraiser who knows your strategy and who knows investors that will allocate to your strategy for a fund of your size and stage and age. Otherwise, you'll be pushing a string uphill. You're going to get nowhere fast. Slide 19. Again, contact the appropriate investors and the correct person. We've covered this a little bit. So at Crawford, we have relationships with about 1,000 institutional investors and family offices. And sometimes allocators will say to funds will say to us, so Evan, you're going to call the 1,000 investors and raise us money. And my initial reaction typically or always is, good Lord, no, for a couple of reasons. Reason number one, I can't call 1,000 investors. There's only so many hours in the day. We can work a great 60-hour week, 80-hour week sometimes. We can't call 1,000 investors. But more importantly, there aren't 1,000 investors that are great fits for a fund. So how big is the investor? How big is the fund? Do they allocate to quantitative strategies? Do they allocate to emerging managers? What's the geography? I'm not going to call a sovereign wealth fund in Singapore to raise money for a small emerging manager in New York or California. So we actually take out our investor list and take out a yellow highlighter, take out the Sharpie yellow highlighter, and actually highlight out of the 1,000 allocators which ones are going to be the most appropriate to raise the most money for this fund the most quickly based on the things I mentioned before, the size of the fund, the stage of the fund, geography, how well I know them, and so forth and so on. And also too, as I mentioned on this slide, I think somewhere, make sure you're speaking to the right person at a larger institution specifically. If there's a dozen or 24 people, and in some places 50 people, at a big endowment, foundation, or pension, or multifamily office, or OCIO, they're going to break it down by type of asset again, long only, hedge, venture. We've joked that certain people handle hedge funds whose names begin with a vowel, and certain people handle hedge funds whose name begins with a consonant. Of course, I'm joking when it comes to that, but you get the point. So, the first thing is make sure you don't waste people's time, including your time. And, just because you found somebody who works at a pension or an endowment or foundation, just don't dash off your hedge fund or private equity docs. Make sure you've gone on the website, done your research, or most importantly, have a fundraiser who already knows all of this stuff in the first place. So if Billy does hedge funds, Susie does private equity, you're not sending Billy private equity and Susie hedge funds. And, on the hedge fund side, they even get a lot more granular. So if Billy does long-short equity and Susie does quant, again, make sure you're focused and pitching the right person, the right fund, because otherwise it's going to go into a black box. And again, you're going to get nowhere fast. Going to slide 19, and we've touched on this a bit. I'll say one last thing about emerging managers. And this is one of my biggest pet peeves about the hedge fund industry. It's a ridiculous situation. Pick your favorite sport. If you are the best basketball player, baseball player in high school, you're hitting 3 home runs every game, scoring 30 points on the basketball team, the colleges will find out about you. And if you go to USC and you're scoring 30 points a game and throwing 4 touchdowns and hitting 2 home runs a game, the pro teams will find out about you. What in the world has got to do with hedge funds and investing? The problem is that for a lot of reasons we don't have time to get into, you can be the world's greatest money manager in whatever your style is, long only, hedge, venture, private, whatever. And you can put up great numbers for 1,000 years, and you're still not going to ever be running $1 billion unless you learn how to build a firm and a team. It is just an incredibly fragmented business, very relationship driven, even with the internet, even with databases. I've met most of the investors out of the 1,000 allocators we work with. I've met and spoken with them typically each dozens and dozens of times. It's a very fragmented business, a lot of networking. So if you are an emerging manager, definitely get someone on board who knows the folks who will invest in emerging managers. And that's typically mostly family offices, but not always. There are several dozen big institutions we know that allocate to so-called emerging managers. And the reasons are very simple. It's like the famous late senator from New York, Daniel Patrick Moynihan. His most famous quote ever was, "You're entitled to your own opinion, but not your own facts." And the facts are emerging managers tend to produce better returns than most established managers. They tend to produce returns that are on the hedge fund side 100 to 300 points higher per year, basis points higher than established managers. And yet some people are afraid of emerging managers, and people say why? They produce returns a couple of 100 basis points larger. They can be more nimble. They can be more hungry. They're not resting on their laurels, getting 1 or 2 or 1.5% on a couple of $1 billion. So why are people scared of emerging managers when all the surveys shows they tend on average to produce the best results? Yes, they tend to have a few more blow-ups. That is true. And the reason simply is career risk. Unfortunately, there's a conflict of interest. What do I mean by a conflict of interest? It's a lot of the people working at the family offices, the foundations, the endowments. If they bring in a great manager, ABC Capital, XYZ Capital, and they do great, they get a bigger bonus, a pat on the back, a more firm handshake. Okay, great. But if they bring in a manager that doesn't do well or has a big issue, they can lose their job. So-called career risk. If it's a huge fund, they can blame it on the manager. I'm not going to pick on anybody, but multi-billion-dollar fund, so-and-so had a bad year, they blame the manager. If they bring in a small or medium-sized firm, that person's out of a job. So again, that's something to be bear in mind about emerging managers. So definitely make sure you're picking the folks who are well connected with emerging manager investors. Point V may be pretty obvious, but I got to tell you, There are some people in the hedge fund and finance industry who have big egos. I know this comes as a complete shock. Yes, there are actually people in finance who make a lot of money who have big egos, and there are some people who are nicer than others. And first of all, like your mom and dad told you growing up, there's never an excuse to be rude to anyone. But also, when at the foundations and the endowments and the pensions at the big shops, a lot of the administrative assistants are the ones who schedule the meetings. So, I mean, look, obviously, let's be clear. If your fund is horrible, the team is bad, you're always losing money, it doesn't matter how nice you are to the administrative assistants, and you can send flowers and chocolate. Doesn't matter. But the truth is, your fund can be good or great, and a lot of times it's how you treat people who oftentimes will help get you to the top of the stack because bizarre as it is, they're often somewhat of the gatekeeper. So be nice to everyone, but especially the administrative assistants. Slide 21 is worth a brief comment. Make a fund video. I will say that 99% of the funds that come to us, out of the 300-400 here that come to us, 99% don't have a video. And some people present better and some people don't. But in today's world, you know, we live in a YouTube world where everybody gets their news on video and people are watching TikTok and all this stuff. So right now, an investor has a choice. If you want a meeting with them in person, by phone, it's going to be an hour preparing. You may or may not get it. Have your PM, your portfolio manager, make a 2 to 3 minute, no more, video of what he or she does. And in addition to your PowerPoint and in addition to your one pager, this will go a long way. It basically says to investors, all right, we can invest 3 minutes to watch this portfolio manager tell us about his or her fund. And we've used this as a great way of sort of having an in-between step between reading a doc and taking a 2-hour meeting or a 1-hour meeting with an hour of prep. It's a great trick. People love it. And we've gotten great responses from investors on it. One of the questions we get frequently is, how often should I follow up? It's a great question. And I said before that following up with investors is kind of like dating. If you go out on date 1 on a Saturday, when do you follow up? If you follow up too soon, you're a stalker. Same thing on the hedge fund side. You follow up too often every week, you're a stalker. They'll shoot you. They won't take your calls anymore. If, on the other hand, you wait too long, just like dating, you waited too long. What's too long? You know, it's hard to say, but we've been doing this for 20 years. I'd say we basically use what we call the TikTok scenario. We call investors once a month to touch base on how wonderful our fund is doing and to try to move the ball along. And we email them our update once a month. So just to put it out there, if you email the update at the beginning of the month and you call them in the middle, you're calling them once a month, you're emailing them once a month. There's no perfect science here, but that's pretty close to optimal. And we've been studying this for roughly 2 decades. Obviously, there are some investors who say, Evan, we love you, man. Don't call, just send us the docs. When we're interested, we'll call, we'll invest. And it's not a lot of them. A lot of them are open to phone calls, but needless to say, for the investors that say email, don't call, or call less often and more often, obviously stick to what those investors recommend. Mick, one question. When are we up on time?
We have about 15 minutes left.
Okay, perfect. I'll wrap up the presentation in about 10 and answer questions in about 5 or something like that. Thank you very much. Go into slide 23, and this is a bit in the weeds and so forth. But I've seen people send PowerPoints from hedge funds that they try to cram in as much as possible. The font is minute; it's barely readable, and especially if you're over 40, which I am. Don't do it, and make sure they work on cell phones and tablets. You know, just make sure your documents are readable. Keep it simple, and make sure people can actually read the stuff because a lot of them are reading them on tablets these days. And don't make your fonts so incredibly small nobody can read them. Again, it should be obvious. And point AA I mentioned before, for crying out loud, do not email investors on nights, weekends, and holidays. Again, Captain Obvious. It should be obvious. And yet, there are so many funds that do it. Because we get pitched to invest in funds as well. It's incredible. Several PMs have said to me, but I work on the weekends and get the emails done then. Great, wonderful. Work nights, work weekends. God bless. But tell your email system, send the email out Monday at whatever time, Tuesday, Thursday at whatever time. And it's just shocking how many people don't know it. Again, it should be obvious. You shouldn't need an MBA to know that, and yet some people do. Slide 24, I won't spend too much time on. I think either Mick has or will circulate the deck. It's basically what we've done successfully over about 20 years, and that is in the email header, in the subject line, use the subject line to get people to open the email. Always, always, always put the person's first name. To John or Mary from Evan, colon, following up on the top decile hedge fund we mentioned with the fantastic 20% a year returns. Because people get a lot of emails. And when they get that email, it reminds them, oh yeah, we spoke about this, the fund has great returns. Similarly, in the body of the introductory email, don't go on and on forever. I've gotten some emails from funds pitching me that are this long, 10 paragraphs. It's like the old expression, TLDR, too long, didn't read. Keep it simple. Bullet points are great. Slide 24 is not written in stone, but it's a good example. Name of fund, strategy, track record, since inception returns, Sharpe ratio, Sortino ratio, who the founder is, where he or she came from, AUM, fund structure, who your service providers are, and basically you're going to say, yeah, it's exactly the same thing on the tick the box that we covered a couple of minutes ago. Bullet points, keep it simple. You can look at this and in 5 seconds say, oh, this is a fund, I want to call Evan or whoever is pitching me the fund to speak to him about it. Slide 25, and again, this is a little bit in the weeds, but shockingly, a lot of people don't know this. So always, 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 always send your documents as attachments. Why not Dropbox? 2 reasons. One, a lot of people get sketched out about clicking on attachments. They get lazy, they don't want to do it. If you want someone to do something, make it easy for them. When you send your hedge fund documents, your PE, your VC docs, send them as regular attachments, number 1. So it makes it easy for someone to look at your documents. Number 2, when they're preparing for a call, I and many investors will say, oh shoot, where did I put those documents from ABC Capital, XYZ Capital? The PM is Mick Swartz, where did I put them? And I'll search my email for Mick Swartz and the and attachments. And I will put that in my Outlook or whatever I use, my Gmail. And if I say, where's the documents Mick sent to me with the attachments? If you send them as Dropbox links, the investor's not going to be able to find them. There were no attachments. Always send them as attachments. And the last thing to, again, get into the weeds a little bit is a lot of investors have Dropbox blocked. So this is kind of where amateur hour comes in, where people have never done a fundraise before, and they're using tools that you use when you send your friend or your parents or one of your buddies something to look at. A lot of institutional investors have Dropbox blocked. Why? They're not concerned about them downloading your fund documents. They're concerned about sending documents up. So if you work at Goldman Sachs, Morgan Stanley, Harvard, teachers of this, firemen of that, they don't want you being able to send documents out without authorization. So again, Dropbox is locked. So again, to beat a dead horse, send them as attachments so people can open your documents and they can open them. Same thing with Bitly, the link shortener. A lot of places have that blocked for security reasons too. So moving on to slide 26. Oh, yeah, that is one last reason for always sending fund documents as attachments. A lot of times people before COVID, during and after COVID are on airplanes. If you send your documents as Dropbox links, unless the Wi-Fi in the airplane is pretty good, the investor can't download your stuff easily on Wi-Fi. If they're on Amtrak and there's no Wi-Fi, again, send them as attachments. And then point FF, some investors are more phone friendly. Just know your investors. Call the ones who want to be called. Email the ones who want to be emailed. Slide 17. This is, again, Captain Obvious. This is incredible how many people do it. We get pitched by hundreds of funds a year, and there are some funds and service providers that, no joke, will call us persistently until they try to get us on the phone. And we're typically back to back all day long with prearranged calls, and I'm not kidding. They will keep calling, and guess what? Every person has caller ID. Every investor has caller ID. You do not want to be that man or woman and fund that's showing up on someone's caller ID, calling every day or more than every day or every week trying to get someone on the phone. I mean, it is probably the first way to get put to the bottom of the list or to be taken off the list. Again, I never thought after 7 years of higher education I'd have to put this in a PowerPoint, but again, Captain Obvious, but people actually don't know that. Point HH, millennials. This is actually something worth mentioning again. People often ask us, well, we've been more successful how we've done better, our secret sauce, whatever. I often say one of the reasons we do better and raise more money in less time than our secret sauce is what I call my secret weapon. It's called a telephone. I actually pick up the phone and call investors whom I've known for 10 to 20 years, typically 12 to 15, and actually get them on the phone, have a conversation about a great fund with a great team and a great track record, and you raise a lot of money for them. Studies have been shown, no joke, that millennials, whatever the next generation is, I'm not kidding, is so used to texting and emailing and Instagramming, they literally don't pick up the phone as much as they should. There's a Wall Street Journal article, I should put the link in here. Actually, I think it is here. Bosses say pick up the phone. Actually, there's a hyperlink. So when you get the PowerPoint, you can click on the hyperlink, and it will take you to a Wall Street Journal from about 5 years ago, discussing how companies have had to teach people, this is a telephone, pick it up, call people. You can't just email people documents and expect them to say, sure, here's $100 million. Going on to slide 28, we mentioned the TikTok calls and emails. Point JJ, though, holding back some documents is worth mentioning. Again, I've seen people hit us up to raise them money who send like a half dozen documents. We're getting hundreds of funds a year pitching us. The investors are the same way. Do not send 7 or 8 documents to an investor on the first email. Again, this should be so obvious, like be nice to the administrative assistants. It's shocking. Eyes glaze over. You have a much better chance of getting your stuff read and getting to second base, third base eventually if you send 1 or 2 documents, your one page or your PowerPoint. The other reason is not only is it better not to hit them over the head with a dozen documents, which is way too much, but if you hold some back, you have then a quote, air quotes, excuse and a reason to send them a follow-up email in 3 weeks or a month because you didn't send them every document at first. Again, should be obvious, but if we're obvious, I wouldn't have a job. Slide 29. Don't give up, keep following up. I think I should register the trademark polite persistence. In some ways, raising money is like dating. If you call every day, you'll typically scare the person off. But in some ways, it's not. Most investors will give you a clear no thanks if they're not interested because they don't want to keep getting your calls and your emails. A lot of them are busy. They're all busy. So just because you've not gotten a response, do not give up. I cannot tell you how many investors I've raised capital from where they didn't get back to me for weeks or months at a time. They were busy, they were focused on something else, they were dealing with some internal issue. Most investors will tell you no thanks if and when they're not interested because they don't want to hear from you anymore. Do not give up. I've gotten a lot of quick yeses, a lot of medium yeses, and a lot of slow yeses. So don't give up. And at the bottom of the slide, polite persistence. Slide 30. And we're getting a little inside baseball. I'm going to wrap up in a second or two to save time for question and answers. I'll probably skip over slide 30 a little bit. We've covered some of it. I would say read through the PowerPoint when you get a chance. Slide 31 we covered again. Use the subject line to get people to open your email, and then use bullet points. And slide 31 is a good example of how to get the most attractive content into the 100 characters of your subject line. But don't make it too long. Slide 32, Captain Obvious, number 5 or 6. For crying out loud in your cover email, don't say see the attached update. Who in the world does this person think they are? You're asking someone who could potentially invest $50 to $200 million in your fund to figure it out on their own. Have the bullet points, have the summary of the update. So it's kind of like, what's the old expression, Goldilocks. Your cover email should be Goldilocks. Not too hot, not too cold, not too long, not too short. Cover emails, and we've seen both. It should not go on for 5 or 10 paragraphs. It should be a bunch of bullet points and a few sentences. We've also seen the opposite, where it just says, please see attached update. You got a much less chance of getting them to actually look at it if you just say, see that, versus actually telling them what it says. And at the bottom of slide 32 are a couple of suggestions on how to do that. And again, slide 33, don't make it too long either. Keep it short, keep it punchy. Slide 34, for meetings, Zooms, and calls, be prepared, be on time. In the days, we've been doing a ton of investor stuff during Zoom. And this has opened up a whole new world where every investor's got Zoom now. Be prepared, be on time, test your technology beforehand, have a virtual background that looks presentable. I will quite seriously tell you, out of all the compliments and whatever we've gotten over the past decades for hedge funds and fundraising, whatever, this virtual background behind me, we've gotten more compliments than anything we've ever done over it. And we went through about a dozen versions, the type, the size, the color, look the part, be on time, be prepared. Slide 35. Ask the investors for an update on their end. Start off the meeting or the Zoom ask them for an update on their end with their team and what they're looking for. It just shows that you're concerned about them. You're trying to develop a relationship, understand the latest and greatest. It's a lot of free reconnaissance and intelligence. Take great notes, and then you can customize your pitch and your follow-up to what they're looking for. Don't just be, hi, I'm Steve, I'm Mary, here's our fund, here's why it's great, give us money. If you can find out what they're looking for and how you can add value, you'll raise a lot more money in a lot less time, and obviously take notes and follow up promptly. The next slide, slide 36, double why promptly. Doesn't have to be in 5 minutes, but follow up promptly, take good notes, get back to them, have all their answers ready before the call. But if there's a couple things to follow up, definitely follow up promptly. Don't take forever. There's been a couple of situations, most of the managers we've raised capital for are really good. They answer questions, they get back to people, they provide information, but there have been a couple of them who take forever. And like one large allocator said to me, he's like, Evan, fund sounds great, we love you, but if it takes your fund a long time to get back to us before they've got our money, how long is it going to take them to get back to us after they've got our money? And that's what the bottom of slide 36. So as Woody Allen once said, 90% is showing up, show up, be on time, answer questions promptly. I'll say one thing about fundraising during COVID, and I'll go to the questions. There are now a ton of cap intro events online. Nothing has ever good come out of a global pandemic, but now everybody's got Zoom. And so now I think we're looking at a hybrid of a combination of Zoom and in person, and the whole will be greater than the sum of the parts. If you can become great at Zoom and in person and go to the in-person events and Zoom, you'll raise a lot more capital. Obviously, dress and groom appropriately. I've seen some PMs hop on Zooms with us, look like they just rolled out of bed. The lighting is horrible. The microphones are horrible. I'm not saying you need hair and makeup and a $20,000 home studio, but for crying out loud, invest some time and some money. So I think slide 38 talks out a little bit. Get a Zoom virtual background, make it look professional, be reasonably well dressed for the occasion, try out the lighting, and we do this to everybody out. All the funds you raise capital for, we make sure the lighting is good, we make sure that the computers, the technology are fine, there's no big window in the background glaring at people, they've got one of those little ring cameras on the computer. As I like to say now, you're asking people for $100 million and $200 million, spend $100 or $200 on your home setup. And that's slide 39, and we'll wrap with this shortly. The 220 rule, I call it the 200 rule. Invest a few hours and a couple $100 on technology where you can be heard, you can be seen. I'll never forget one manager was pushing back with me tremendously, and we started getting on investor calls. The first thing they said is, "I'm sorry, we can't hear you." And the guy got a microphone for $40 on Amazon and wondered why nobody could hear him. And then he started listening to me after that. It's like the two funds that had the weird fee structures, the two of them that didn't listen, we spent half our time talking to investors about the weird fee structure. So, if you hire a great fundraiser, listen to him or her, because hopefully he or she knows what he's doing. With that, slide 40, Q&A. I guess, Nick, should I go to the 9 questions that were submitted?
Maybe. Do we have any other questions right now? Go ahead.
And slide 41, actually, if you want to go to slide 41, it's contact information. It's on our website, if you want to leave that up. Anything with hedge funds, investing, careers, fundraising, you name it.
Go ahead.
Yeah, I do have a question about the multifamily office. So how do you think about the growth of the FFO, and how do you see that would impact the hedge fund?
Sure. Mick, can you repeat that, the
Yes.
question, please?
Yeah, so she was asking about the multifamily office and how do you think that will grow in the future, and what impact will that have on the hedge fund space?
Well, I think multifamily offices have been around, and thank you for the question. Multifamily offices have been around for a long time, and basically they serve the small and medium-sized family offices that typically cannot have full blown-out staffs for every possible investment strategy. So I'm not sure they're going to be impacted by COVID one way or the other. I just think they're on a pretty steady growth path because they provide a valuable service, and there's enough customers to go around. So putting the question more broadly, I don't think we've seen too much change in the nature of investors and allocators, except of course, everybody's doing Zoom. All the conferences now have virtual abilities. And it used to be, hey Evan, the fund sounds great. Where are they located? New York, California, Texas, the Midwest, wherever. Okay, all right, the team and I, we're gonna be in one of those cities in 3 to 4 months. We'll do a call next week and we'll do a meeting when we're there. Now, they're typically jumping right into a Zoom, and Zoom cannot replace in-person. We all know that, whether it's dating, keeping in touch with people, your friends, your family, Zoom video is not in person, but it really can accelerate things tremendously. So by the time we're doing investor calls and Zooms now, by the time we've gone through 1 or 2 investor Zooms and calls with investors and our funds, things are progressed dramatically in terms of how well the investor knows the fund and how well the fund knows the investors, and the screen sharing and documents and everything else. So, again, nothing ever good came out of a pandemic, but that is one thing that there's definitely been an acceleration where investors can get to second or third base, so to speak, with managers much more quickly than it was just a phone call. So I hope that answers your question. Happy to take the next one.
Thank you so much. May I actually ask a follow-up?
Go ahead.
So
Sure.
how do you think that like if a MFO would usually take multiple hedge funds, or would they only stick on one?
Say that again.
Can you repeat that, please?
Yeah, so with multifamily office, usually pick like different hedge funds at the same time for them to invest. So would they have like different hedge funds, or they would only cooperate with one hedge fund association?
Oh,
Mick, can you repeat that again, please?
Yeah, she asked that the MFOs, do they pick one hedge fund or do they pick many? In other words, in a particular asset class or strategy?
Oh, sure. Yeah, thanks very much. Yeah, I'll answer the question this way. The MFOs are typically, except for some of the tax stuff we covered or return profiles, they're typically like all the institutional investors, the endowments, foundations, and pensions. So if they've got a dozen or 2 dozen people working there, they break it up by type of strategy typically. This group does fixed income, this group does long only, this group does hedge funds, this group does venture, this one does real estate, this one does energy and resources. And so they may divide whatever billions of dollars they're running among all those different types of strategies. Then underneath those strategies, you then have typically, at least half a dozen, probably a dozen or 2 dozen hedge funds, venture firms. I mean, it's the same sort of investment model. Diversify, across